You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, listeners should know that options involve risk and are not suitable for all investors. Individuals should not enter into an options transaction until they have read and understood the disclosure document, characteristics and risks of standardized options, available by visiting the OCC.com or by contacting your broker, any exchange on which options are traded, or the Options Clearing Corporation at 125 South Franklin Street, number 1200, Chicago, Illinois, 60606. The Options Industry Council is an industry resource provided by the Options Clearing Corporation, collectively OCC. Any strategies discussed are strictly for illustrative and educational purposes only and are not to be construed as an endorsement or solicitation to buy or sell securities. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options, and the Wide World of Options radio show is one of several resources investors can utilize to learn more about options. Other resources OIC offers include webinars, articles, and self-guided options-related coursework. For more information, check out www.optionseducation.org. Now, here's your host, Mark Benzaquen.
Hello, everyone, and welcome to another episode of OIC's Wide World of Options. My name is Mark Benzaquen, and joining me once again in the studio today is my colleague, Roma Colwell, a 25-year options veteran with roles ranging from market maker to risk and portfolio manager, amongst others, and a fellow options instructor here at OIC. Roma, welcome back.
Hey, thanks, Mark. I'm happy to be here.
So, Roma, as you know, we're wrapping up our summer of spreads here at OIC, and we'll be concluding with two upcoming webinars that you're going to be presenting this month, which are going to focus on calendar spreads and diagonals, which, in my opinion, I think are two strategies that really don't get a lot of face time, it seems. So to better understand their usefulness, I thought it might be a good idea to bring these two strategies into the spotlight. Sound good?
Yeah, sounds great.
Okay, excellent. Roma, let's go ahead and start with calendar spreads. What are they and how do they work?
Yeah, so calendar spread is, it's basically a time spread. It's also known as a horizontal spread because basically when you're putting on these trades, you're looking at using the same strike. Now, the calendar spread is what it sounds like. You're doing a trade where you're either trading a short-term option along with a long-term option or vice versa.
Okay, that's interesting. So can you walk us through an example?
Sure. So if I'm looking at doing a calendar spread, the first thing I would be thinking about is what my forecast is. We would be looking at something where if I'm buying a calendar spread, so throughout the presentation, we're really going to be concentrating on buying these time spreads. So if I'm buying a calendar spread, that means I'm buying an option that's a far dated option, and I'm selling an option that is near term. Now, what I'm trying to do there is capture two things. Decay that I'm going to get from the near term option, which is going to decay, faster than what our long-term option is, but I'm also getting that element of implied volatility along with it. And both of these, in this particular strategy, we are using the same strikes to implement this calendar or horizontal spread.
Okay, so you're talking about capturing that decay, which is something that you mentioned a little bit ago. I'm assuming you're talking about time decay, right? And that's why it's called one of the terms that people use for a calendar spread is a time spread. And I'm assuming that's the rationale behind that, right? You're looking to capture that decay?
That's right. You're trying to capture the decay for that front month option, that near-term option. Now, time decay is also known as theta. So if you're trading the Greeks, you will know what that theta number is and what that expectation is for that front month. But since we're buying, the back month, which also has theta, generally the theta, that time decay in that front month, is greater than what you'll find in the back month. So that's part of what we're trying to capture calendar spread.
Okay, and the difference between the two decay values, the front month versus the back month, that is because we know that time decay isn't linear, right? It accelerates as expiration approaches. So what you're saying is that we're looking to capture that differential between the theta of the long-term option and the theta of the short-term. Is that correct?
That is correct. So if we're looking at that short-term option, and let's say that daily theta is, 3 cents, so we know that that's going to decay by 3 cents, and then of course that's going to get accelerated as we really get closer to expiration. But that far-term option may have a theta of, we're going to say 1 cent, right? So when you're combining those, that differential between the two theta is really what we're trying to capture. So that short-term theta where we're getting 3 cents, and then of course we're paying a penny for the other one. So each day we're getting 2 cents. And again, as we get closer to expiration, that theta number for that near term will accelerate just by the nature of how time decay works.
Okay, excellent. That makes sense. Something else that you had mentioned earlier on calendars and something that I want to switch gears to look at, you had mentioned implied volatility. How does implied volatility impact calendar spreads?
Yeah, well, implied volatility is a really interesting concept when it comes to trading calendar spreads. So let's start with an example, right? So we're trading a stock, it's a $100 stock, and it's going into earnings, right? So typically what happens is that front month, right, that's closer to earnings, the volatility you'll see has a greater impact, right? So that volatility is going to move up on your front month. It's going to have, because earnings are, let's say, 2 or 3 days from now, the back month option, that far term option is not going to be really as impacted as that front month is, where the earnings are going to, come out in a couple of days. So that front month, because we're going to see that volatility happening, or that increase in volatility and implied volatility, this is a way to capture that increase. So you're going to see less of an increase in the far term, greater increase in the near term. So if you were to put this spread on, right, you're basically buying that cheaper implied volatility and selling that more expensive implied volatility. You also know that more expensive volatility is likely after the event or after earnings are announced, you're going to start to see that come down. So this is a way of capturing that differential in implied volatility between these 2 months.
Okay, that makes sense. Now, you're mentioning expensive volatility or cheaper volatility, et cetera. Some people talk about relatively high or relatively low. What do you think? What do you mean by expensive? And now, are you saying that, for example, a 90? Are you saying that a 90 vol, an implied volatility level of 90, is that expensive versus an implied volatility level of 30? How would, I guess what I'm getting at is how would an investor know whether or not volatility is cheap or expensive? And basically, what does that mean?
Right. And Mark, that is such a good question. And so relative value, and I'm just going to, tell, everybody out there, like when I was trading options, when you're a market maker, you basically trade volatility. As a retail trader, usually they're trading strategies. So when I was trading options, one of the things that I always had a note, next to my computer was historical implied volatility, right? So I could, when I was looking at my options on a particular stock, it would say, the lowest implied volatility in this particular stock was 30, and the highest that it got to was 70. So that was kind of my parameters when I was deciding whether or not I wanted to buy or sell volatility. So when we're talking about relative volatility, that is kind of what we're looking at, right? So if I know that the average volatility for that stock, right? So I know that the high is 70, the low implied volatility is 30. If it's sitting at a 50 volatility range, I would say that's pretty neutral. But if it was trading 90, let's say, I would say that's relatively high compared to what that average is. If it was trading 30, I would say that's relatively low compared to that average. Now, there are plenty of stocks out there where that range is closer to, the low range is 80 and the high range is 160, right? So if I'm looking at a stock that's trading 90 in that particular scenario, I would say, oh, that's cheap relative to what I know that, historically what implied volatility is.
Okay, that's great, Roma. Thanks. So what we're talking about relative implied volatility, we're not saying that a 90 vol is high. We're saying that the investor should really take a look at where volatility has been historically, and that helps determine whether or not volatility is high or low relative to where it's been in the past. So that makes sense. Excellent. Before we move on to diagonals, which is something that I do want to cover before we wrap up, before we move on, is there anything else that we should think about when it comes to calendars?
Yeah, I would say the last thing that you want to think about is expiration, right? So ideally with a calendar spread, you really want that front month option to kind of expire worthless. And one of the benefits of it expiring worthless is that now you're left with a long, far-term option. And that effective value of what you now essentially are holding that option, the price of it has been reduced by the amount that you collected for that option that expired worthless.
Okay, I get that. That makes sense. Thank you. So when we talk about calendars, we should consider a relationship between implied volatility and pricing. We should look at time decay, certainly as well, and we should consider different expiration outcomes and how that might affect the position overall. So thank you for clarifying those important points. And now let's shift gears to diagonals. what are diagonal spreads and how do they differ from typical calendar spreads?
Right. So, the calendar spread, there's two factors that we kind of are measuring, right? And that's the time decay, and, it's also that implied volatility. Those are kind of the two factors that we're looking at. When you're doing a diagonal spread, the addition of, there's one additional aspect that affects the price of a diagonal spread, and that's actually the underlying stock price. So whereas with the calendar spread, that the price movement for both of those options, if there's a price movement, you're going to see, because we have the same strike, if it goes in the money, they're going to have the same intrinsic value. They'll have, the different time value. But when you're doing a diagonal, now the difference between them is with a diagonal spread, we're now using two different strikes. And because we're using those two different strikes, that actually adds in the component of a stock movement having a different effect on that spread that you don't get from a calendar spread.
Okay, so when it comes to spreads, we've got three different types, basically. We've got the vertical spread, where you've got the same expiration period but different strikes, and the idea behind that is to capture stock price movement. We've got the calendar spreads, which we just talked about, which is a different expiration period, but the same strikes, and we're looking to capture time decay and or changes in implied volatility. And then a diagonal is going to be a combination of the two. So to reinforce what you just said, not only are we looking for that time decay and the implied volatility from the calendar, but we're also looking for that stock price differential. So yeah, that sounds like a fairly complex, structured trade.
I'm just going to add something that you had mentioned, which is the vertical, right? So imagine having a vertical, right, which is going to expire like on the same day when you have a vertical. Now, with a diagonal, take that same vertical spread, but give yourself some time, right? So you're going to take one leg of that trade, and that one leg is going to be a front month, and you're going to give yourself some time by taking the other leg and giving you time on that. And so typically, you take that vertical spread, you'll take the long side of that vertical spread, and now give that time. So you could go out, 60 days. So you're taking that vertical where you're going to have that short option expiring, right? And these vertical spreads, the expectation is that you're going to get some price movement in the underlying. If you add that diagonal or that time into it, then you have a whole new component where you've given yourself, 60, 90 days for all of that to play out. But it's still very similar conceptually as a vertical.
Okay. Something just occurred to me, Roma, while you were just providing that explanation. I was thinking about diagonals, and I remembered that there is a strategy out there that retail investors do use, something that we're all familiar with, the covered call. But what it just occurred to me was that there is a version of the covered call. The covered call, for those listening, I'm sure everyone remembers, is simply long stock and a short call that's sold against it. But rather than buying that stock, investors could use options to replicate that stock with an option. So that in of itself is a diagonal, is it not? The poor man's covered call is what I'm talking about. Isn't that a diagonal spread?
That's exactly what it is. It's a diagonal spread. And of course, typically they're using leaps. So that long option is going out a year or 2 years, and that long option is to replicate the underlying stock. But the nice thing about, or the interesting part of using the diagonal is you can actually shorten that time frame, right? So you don't have to be a year out. You can do the 60 days out. But the concept is the same as that poor man covered call. You're just moving that long end of it closer to expiration. You know, it's not a year out now. It could be 90 days out. But that 90 days may be a little bit easier to predict, or at least have a forecast than that forecast a year out, where there's all kinds of things that could happen in between that time frame.
Okay, so getting back to the poor man's covered call specifically, the idea behind that is rather than buying stock, let's say if stock's trading at $100 a share, rather than buying $10,000 worth of stock and then selling calls against it, you could buy, as you had mentioned, a leap contract, a leap call option. And typically, I think with the poor man's covered call, investors generally turn to a deep in the money long-term call with the idea that those deep in the money deltas will more closely mimic the stock. So the idea is that you can still accomplish the same thing, capture that price appreciation through rather than through the stock, but in this case through the long call, and then you generate premium income by selling those shorter dated calls against it. You're doing it for a significantly less upfront capital expenditure than you normally would with that traditional covered call. What other advantages or disadvantages do you see with that poor man's covered call strategy?
Yeah, I guess the one difference is, we'll harken back to talking about Greeks, is the delta, right? So like Mark had said, like you're using an option that is deep in the money, and you want it to mimic the movement in the stock as closely as possible. But it's a lot of times that there won't be an option. 100 delta option moves 1-to-1 with the underlying, right? So if you're using a covered or a poor man covered call, the delta of that long-term option could be probably, to 80, right? So for every dollar underlying, that option is going to move 80 cents. And so that's kind of one of the downsides, but I would say the upside is just cash outlay, right? If you have a stock that's trading 100 and you want to buy 100 shares of that, you're talking about a $10,000 investment. And if I wanted to buy a leap, that investment is going to be less because that option is just the right to buy it at $100. But I'm buying an option that, has built-in premium, and a lot of that is new. But I get an opportunity to buy that leap, less money, and when the stock is moving, even if it's the option's moving 80 cents for every dollar, I'm still getting the kind of movement that I want. And then, of course, I've got the time decay from my front month option working for me.
Okay, excellent. Any other specific factors or considerations that traders might want to keep in mind when using calendar spreads or diagonals?
Yeah, I would say the last thing about a diagonal is typically you would, on the purchase side, right? So we're looking at buying an option that is 60 or 90 days out, and a lot of traders decide that they want to also, again, mimic what's going on in that underlying as close as possible. So they're going to select a strike that's close to where the stock is trading. So you're going to be buying either an in-the-money option or just out-of-the-money option, but in the money or at the money, pretty close there. So that's the option you're buying 90 days out. And the option that you're selling for this diagonal is going to be an option that is out of the money. So the expectation is when the stock is moving your way, that option that is, in the money or at the money is going to move. And the closer it gets to actually the strike of the option you're short, the outcome is more profits, because that's the expectation for this diagonal, is that the option, this underlying stock moves as close as it can to that short stock that you're having.
Okay, that's excellent. Thank you. One thing I just want to clarify, that when we're talking about the parameters of the trade, when we talk about the setup, and we're saying, typically we use an out of the money option, or we use an in the money, or, a certain delta. These are really just kind of parameters for the traditional trade, or how it's typically set up. Obviously, investors can use whatever strikes they want. We are not making a recommendation or providing advice that that's what investors should do. We're just really just outlining how the trade is traditionally created. Roma, before we wrap up, any final thoughts or key takeaways for our listeners?
Yeah, I think the key takeaway is come and listen to our webinars. There's going to be a lot more information for you on those, and we'll be using examples, so you'll be able to see some examples, and we'll delve into both of these spreads greater. But this is kind of a teaser for getting you to come in and enjoy our next webinar on these topics.
Yeah, absolutely. The webinars will certainly be much more in-depth, and as you had mentioned, providing visual examples for the investors to better understand what it is that we're talking about today. Roma, thank you so much for joining us and sharing your expertise on calendar spreads and diagonals. I appreciate it.
Yeah, no problem.
Excellent points, Roma. Thank you. But I don't want to let you go just yet. I want to pick your brain about one more thing if you have time. Rumor has it that you are a super fan of Korean pop music, also known as K-pop, which I've got to tell you, I find incredibly surprising. But, as I want our listeners to get to know us as presenters a little bit more, and a little bit more on a personal level, Roma, the floor is yours for the next few minutes. Tell us about K-pop and why should we care?
Okay, so, all right, you just called me out on one of my favorite things. Usually I discuss this with my kids who really could care less. But yes, I am a huge K-pop fan, and I hate to admit this, but I've got probably close to 500 K-pop songs on my playlist. But that being said, yes, even though I don't speak the language, I think that when you're listening to any music from any language, you can actually hear the emotions that go along with it, the music. I love to dance to music, so K-pop really kind of fits into that. And nowadays, I don't have to know all the lyrics. So yes, I am a huge K-pop fan. I listen to it just about every day. My favorite band is BTS, and if you really wanted me to delve into each one of the people, I could do that, but we'll just leave it at that.
Oh, that's so funny. I love it. And like I said, when I first found out that you were a raging K-pop fan, I was amazed. I thought it was wonderful. So, and your point about not understanding the lyrics, but still being able to embrace and understand the emotion that the music gives you, I think that's wonderful. So, you know what? As they say, you do you, Roma, and we love everything about it. So thank you again for that. And thanks again for joining me in the studio and sharing your insight into spreads and K-pop. And thank you to all of our listeners and supporters out there. Be sure to tune in and register for Roma's 2 upcoming OIC webinar events in August, the first of which will be a deeper dive into calendars that we had discussed today. And that's going to take place on Wednesday, August 9th. And the following week, Roma, you're going to be talking about diagonals and that four man's covered call specifically, and that's going to be August 16th. Listeners, you can register for Roma's upcoming webinars via the events section of our OIC website, which is optionseducation.org. And as always, please feel free to send us your questions via email at options@theocc.com or a live chat with us on our website. Roma, thanks again for joining us. Thanks again to all those that are listening, and we'll be talking with you again very soon. Take care, everyone.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you've heard on today's show, email options@theocc.com or visit www.optionseducation.org and chat with OIC's Investor Education team. Interested in connecting with OIC on social media? Subscribe to the OIC YouTube channel, like them on Facebook, follow them on Twitter at options.edu, and follow their page on LinkedIn. Thanks for listening, and be sure to tune in to the next episode of Wide World of Options.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.